Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Sonic Automotive Inc. Annual Report. Sonic Automotive Inc. offers a wide range of automotive-related businesses and services through its three segments: franchise dealerships, EcoPark, and powersports. The company's franchise dealerships segment provides various services including the sale of new and used cars and light trucks, replacement parts, vehicle maintenance, manufacturer warranty repairs, paint and collision repair services, and arrangement of third-party financing, extended warranties, service contracts, insurance, and other aftermarket products. This segment is a one-stop shop for customers' automotive needs. The EcoPark segment focuses on selling used cars and light trucks, as well as arranging third-party finance and insurance product sales for its guests in pre-owned vehicle specialty retail locations. This segment caters to customers looking for affordable and reliable used vehicles. Lastly, the powersports segment is involved in the sale of new and used powersports vehicles, such as motorcycles, personal watercraft, and all-terrain vehicles. The company also provides fixed operations services and third-party finance and insurance services for its powersports customers. In summary, Sonic Automotive Inc. offers a diverse range of businesses and services including car sales, replacement parts, vehicle maintenance, financing, insurance, and powersports sales and services. Unfortunately, I do not have access to the text you provided. However, I can still provide a general overview essay on what might cause a stock price to drop. The stock price of any company, including Sonic Automotive Inc., can fluctuate due to various market and economic factors. One possible reason for a decline in stock price is poor financial performance, such as declining revenue or increased debt. This can lead to decreased investor confidence and a subsequent drop in stock value. Another factor that might contribute to a decrease in stock price is changes in the industry or market trends. If the automotive sector experiences a downturn, or if consumers shift their preferences towards electric vehicles, it could negatively impact Sonic Automotive's sales and profitability. Additionally, external factors such as economic recessions, trade wars, or global health crises can also affect the company's performance and stock price. Furthermore, internal issues within the company, such as poor management decisions, lack of innovation, or regulatory compliance problems, can also lead to a decline in stock price. If investors lose faith in the company's leadership or its ability to adapt to changing market conditions, they may sell their shares, causing the stock price to drop. In conclusion, a combination of internal and external factors can contribute to a decrease in Sonic Automotive Inc.'s stock price. It is essential for investors to stay informed about the company's performance and industry trends to make informed investment decisions. Sonic Automotive Inc. market capitalization of $2 billion is materially smaller than most of its industry peers of roughly $5 billion. Sonic Automotive Inc. trades at a higher price-to-earnings ratio of 17 times and a higher price-to-book ratio of 2.03 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The company exhibits a very high leverage profile, with liabilities accounting for 82% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The company has aggressively reduced its share count by more than 5%, indicating a strong shareholder-focused capital allocation approach. The company have a dividend yield of 2.39%. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline in a given period can be identified by analyzing various key performance indicators. In terms of revenue growth, used vehicles have been a significant contributor, with a projected increase of $167.2 million from 2024 to 2025. Additionally, the parts, service, and collision repair segment has also seen substantial growth, with an expected rise of $167.3 million over the same period. The powersports segment has experienced notable revenue growth, driven by increases in retail new vehicles and used vehicle sales. Specifically, retail new vehicles have grown by 28.5% from 2023 to 2025, while used vehicle sales have increased by 95.1%. The franchise dealership segment has also seen a significant increase in revenue, with a growth rate of 30.4% from 2023 to 2025. On the other hand, certain segments have experienced declines in revenue. Retail new vehicles have seen a decrease of $516.4 million from 2024 to 2025, while fleet new vehicles and wholesale vehicles have also declined by $6.2 million and $18.1 million, respectively. Finance, insurance, and other net revenues have also decreased by $64.7 million over the same period. It is essential to note that various factors can influence revenue growth or decline, including seasonal variations, manufacturer assistance, inventory valuation adjustments, and notable events such as acquisitions and dispositions. Net income and profit margins changes. A summary: the net income of the company experienced a significant decline between 2024 and 2025. The decrease was attributed to various factors, including a CDK outage in 2024 that resulted in a loss of approximately $47.2 million. Additionally, non-cash pre-tax franchise asset impairment charges contributed to the decline in net income by $172.4 million. Profit margins also underwent changes during this period. While fixed operations gross margin increased by 60 basis points and F&I gross profit per retail unit rose by 7%, other areas saw a decrease. Retail used vehicle gross profit margin declined due to higher inventory costs, while the overall gross profit margin decreased from 15.6% in 2023 to 15.8% in 2025. The reasons behind these changes are multifaceted. The company's strategic focus on increasing sales of higher-margin products and services led to some positive outcomes, but also resulted in increased reliance on third-party wholesale auctions, which negatively impacted profitability. Disruptions caused by stop-sale orders, manufacturer safety recalls, and negative publicity or legal proceedings further contributed to the decline in net income. Overall, the changes in net income and profit margins reflect a complex interplay of factors, including strategic decisions, external disruptions, and industry trends. The company's financial performance indicates a significant improvement in its ability to generate cash from its core operations. According to the provided information, the net cash provided by operating activities was approximately $567.4 million for 2025. This figure suggests that the company has successfully managed its day-to-day expenses and generated sufficient revenue to cover them. Furthermore, on page 105, it is stated that the operating cash flow for 2025 is a substantial $1,234 million. This indicates a significant increase in the company's ability to generate cash from its operations, which is a crucial indicator of financial health. The fact that both figures are positive suggests that the company is generating sufficient operating cash flow to meet its expenses and invest in growth opportunities. The company's debt level has undergone fluctuations over the years. While long-term debt decreased significantly from $1,582.8 million to $52.4 million in one instance, it increased by $51.1 million in another. Current liabilities also saw a slight decrease from $2,637.7 million to $2,597.9 million. However, these changes were not consistent across all periods. Regarding interest expenses, there have been significant decreases in some cases. For example, estimated interest payments on long-term debt decreased by approximately $153.9 million. Additionally, interest expenses have decreased significantly from 2024 to 2025 in several instances. However, there are also cases where no significant changes were mentioned or the changes were minor. Overall, while there have been some fluctuations in both debt levels and interest expenses, the company's financial situation has not undergone drastic changes. The company's performance varied across different segments and regions in the recent period. On a positive note, the powersports segment stood out with an impressive 29% revenue growth and a staggering 309% increase in segment income. Franchise dealerships also performed well, recording an 8% revenue growth and a 23% increase in segment income. However, not all segments fared equally well. The EchoPark segment struggled, experiencing a decline in revenue from 15% to 13.7% of total revenue. Furthermore, within the franchise dealership segment, used vehicles only managed a modest 6% revenue growth, indicating room for improvement. Overall, while some segments showed significant growth and success, others faced challenges that need to be addressed by management. Management's outlook for the company is one of growth and expansion. The company plans to acquire dealerships that will strengthen its brand portfolio, focusing on attractive acquisition opportunities with capital and experience. This growth strategy also includes investing in equipment and technicians to expand profitable parts and service business. In addition to acquisitions, management aims to drive growth through customer satisfaction and experience. This is achieved by developing and retaining top talent through comprehensive training and retention programs, as well as optimizing the company's capital structure through share repurchases to return value to shareholders. The company also faces intense competition from various sources, including other auto dealers and service centers. However, management believes that its growth strategy will enable it to stay ahead of the competition. In terms of financial performance, the company expects to see growth in fixed operations revenues and gross profit in 2026, with sufficient liquidity provided by cash flows from operations and credit facilities. Management is also focused on executing tax strategies to realize deferred tax assets and believes that adjusted EBITDA enables operating performance to be compared across reporting periods on a consistent basis. Overall, the company's outlook is one of growth, expansion, and financial stability. The company has made several acquisitions and divestitures in recent years. In terms of acquisitions, the company has expanded its business through various means, including purchasing new dealerships, acquiring additional franchises from manufacturers, and making strategic investments to complement its existing operations. This expansion has been focused on both the automotive and powersports segments, with a particular emphasis on growing its EchoPark and dealership businesses. The company has also made significant divestitures, selling off certain assets and operations in order to focus on more profitable areas of the business. For example, it sold several dealerships and closed down some underperforming stores, including the Northwest Motorsport locations. Additionally, the company has sold off real estate holdings, generating $3.9 million in revenue in 2024. Overall, these acquisitions and divestitures reflect the company's efforts to adapt to changing market conditions and optimize its operations for long-term success. By strategically investing in new areas of growth while shedding underperforming assets, the company is positioning itself for continued expansion and profitability. The company's financial activities have been marked by a commitment to shareholder value. One key aspect of this is the payment of dividends, which demonstrates a focus on rewarding investors for their loyalty. According to the provided information, the company has indeed paid dividends, as noted on pages 27 and 73. In addition to dividend payments, the company has also taken steps to return value to its shareholders through share buybacks. This strategic move allows the company to reduce its outstanding shares, thereby increasing the value of each remaining share. The details of this initiative can be found on page 121. Concerns about inventory buildup or supply chain disruption are evident throughout various pages of the extracted summaries. On page 21, it is mentioned that there are concerns about both inventory buildup and supply chain disruption. This theme continues on pages 30, 31, 32, and 41, where inventory buildup is specifically highlighted as a concern. Furthermore, page 71 notes that supply chain disruptions can lead to cash flow issues, while page 76 mentions the estimated interest payments on floor plan facilities due to inventory buildup and supply chain disruption. The issue of inventory buildup is also emphasized on page 102, with specific numbers provided for 2024 and 2025. Additionally, there are mentions of potential risks related to inventory buildup or supply chain disruption on pages 1, 10, 13, and 35. For instance, page 1 notes potential obstacles related to used vehicle inventory acquisition and liquidation, while page 10 highlights the decrease in gross profit per unit following the COVID-19 pandemic. Overall, these concerns suggest that there are significant issues with inventory buildup and supply chain disruption in the industry, which could have far-reaching consequences for businesses. That concludes the financial summary for Sonic Automotive Inc. Feel free to comment below, and I will be happy to answer them when possible.